Hey everyone, and welcome back to the channel. We've done a few videos like this in the past and received great feedback, so we're going to do it again. In today's video, we're going to talk about 6 popular stocks, and we're going to rank them based on my opinion alone and how ownable they are for my portfolio. Let's begin by taking a look at the 6 popular stocks that we're going to look at in today's video. Number 1 being Apple. Number 2 being Meta Platforms. Number 3, Nvidia. Number 4, Advanced Micro Devices. Number 5, Intel Corporation. And number 6, Alphabet. Here's a look at the categories I will be ranking these stocks in. Number 1 being must own. This is a category going to be saved for the highest quality stocks, looking at the strength of the balance sheet, growth potential moving forward, as well as valuation. Number 2 being high quality. These stocks are obviously high quality companies with solid balance sheets, but may lack as much growth potential that the category above sees. Number 3 category is going to be the like but not love category. And these stocks I like, but I'm not crazy about, either due to quality of the balance sheet, lack of growth, or maybe they're overvalued. And then number 4 is going to be prefer not to own. These are just stocks that I find to have multiple issues, and I just don't want them within my portfolio at all right now. Again, these are my opinion alone, and your ranking may differ than mine, which is certainly okay. With that being said, before we jump into today's video, do me a huge favor. Click that like button down below. Subscribe to the channel so you're notified anytime we drop new content, and let's jump into it. Hey everyone, Mark Rusin here, back for another video. As always, I'm a CPA and not a financial advisor, so please perform your own due diligence. And before we begin, let me thank today's video sponsor, which is The Motley Fool. The Motley Fool has a ton of great resources and products available for investors of all different levels. And right now, if you go to fool.com/Mark, you could sign up to receive their 10 best stocks to buy right now. All right, let's jump back into today's video, ranking 6 popular stocks out there. Beginning with stock number 1, which is Apple, stock ticker AAPL. Apple, as you know, is one of the 2 largest companies on the U.S. market today, recently getting surpassed by Microsoft in terms of largest market cap. Apple currently has a market cap of $2.96 trillion, and over the past 12 months, the stock has risen by more than 40%. Apple changed the technology world forever back in 2007 when they introduced the very first iPhone. They have been dominating the smartphone market here in the US and have at least a top 2 position both here in the US and worldwide. However, over the past few years, the concern when it comes to Apple has been with revenues or lack thereof. When looking at the financial health here, you can see that revenues have gone pretty much nowhere over the past 3 years. In fact, on a quarterly basis, Apple revenue year over year has declined for 4 straight quarters. Right now, the company has revenues of $383 billion over the past 4 quarters or trailing 12 months, which is a decline of nearly 3%. Gross margins are relatively flat at 44.1%, and EBITDA has fallen 2%. Sure, the company makes great products, but I always say it's very important to separate the company from the stock. I love the company. I love the company's products that they make. Many of the products they make, I'm using right now. I have an iPad, an iPhone, a MacBook in front of me right now, but there needs to be a disconnect when looking as an investor. So when you see those crazy results over the past 12 months and what the stock has done, however, when you look at company results, they haven't really done much. So how in the world has the company's multiple doubled and the stock increased 40% when we've seen 4 straight quarters of revenue declines? A lot of investors right now are looking to the services revenue, which still only accounts for 20 to 25% of total company revenues. Not a reason to double the multiple right now when it's still such a small piece of the pie. Before we rank the stock, let's take a look at valuation. Looking here at this fast graphs chart, you can see that analysts are looking for 8% EPS growth in 2024, looking for the company to generate EPS of $6.61 per share, which equates to a forward price to earnings multiple of 29 times, well above the company's 5-year average of 25.3 times. So now we have a little bit more of the details. Number 1, the revenue growth has pretty much been non-existent. Moving forward, there is some EPS growth that analysts are looking for, but a lot of that is also due to the aggressive buyback approach that the company takes. And then lastly, valuation right now isn't all that intriguing. As such, before I rank this, let me tell you again, I love the products, but I'm looking at this with my investor's cap on. Therefore, when it comes to ranking the stock, As much as I want to put them in the like but not love category, I don't think I can, just because the company has huge amounts of cash, strong cash flows, and their ability to innovate. So I feel like they do at least deserve the high quality section. And you may be watching this right now and even been saying that there's no way that it can't be in the must own, but I just personally don't feel that way. So now let's move on to stock number 2, which is Meta Platforms, stock ticker META. Meta Platforms is one of the largest digital advertisers in the world today, and they had a phenomenal year in 2023. If you're a Meta shareholder and you bought shares at least prior to 2023 or even in 2023, the beginning, then you're likely sitting on some huge gains. Meta Platforms, currently being one of the largest digital advertisers, has a market cap of $985 billion, inching ever closer to that $1 trillion mark. Over the past 12 months, as I mentioned, have been phenomenal for shareholders of Meta, as the shares have climbed 180% just in 12 months alone. However, when you do zoom out, if you go back 2.5 years, shares are pretty much flat. So we got to tell the whole story, as the stock did get hammered in 2022. So where does a company like Meta go from here? Well, a lot of analysts are looking for digital advertising budgets to increase in 2024. And it's certainly going to help that in 2024, we have a presidential election, which will add even more spending from a digital advertising space. In terms of financial health, Meta has roughly $61 billion of cash on hand and only $18.4 billion in long-term debt, giving them a very strong net cash position. In terms of revenues, those have been rising steadily throughout the years, with the exception being 2022. However, 2023 has been a strong year, and we will get updated results from the company here very soon. Looking at margins, they are quite strong, hovering right around 80%. In terms of valuation, looking at this fast graphs chart, you can see that analysts are expecting the company to generate EPS of $17.56 in 2024, which would be growth of 22%, still growing extremely fast. That would equate to a forward PE multiple of 21.8 times, which when we look at a PEG ratio using that, you get a PEG ratio of 1.0. Also very intriguing. Over the course of the past 5 years, for comparable purposes, shares of Meta have traded at a multiple of 24.4 times. So you're getting a little discount at current levels. So to wrap it up, we expect digital advertising budgets to increase in 2024, which would obviously be a boost for Meta Platforms. Another growth driver they have is the company still looking to monetize. They're finding ways to monetize the very popular Instagram Reels platform that they have, a competitor to TikTok. The company has a very strong balance sheet with a AA- credit rating, and also a very intriguing valuation. There's a lot to like when it comes to Meta. The one thing I would harp on is the cash burn. And again, this has been fixed in 2023, or it's in the process of being fixed, but they're still burning tons of cash in the so-called metaverse. So if this works out, it could be a huge boom for the company in the near future, or the long-term future, I should say. But if it doesn't work out, they are spending billions of dollars. So that's just something to consider right there when investing in Meta Platforms. Therefore, when it comes to rating the stock, I put them in the high quality bucket, as they have been great to own and they have multiple levers to apply for growth moving forward, including their main one, which is digital advertising, as they have tons of customer data. And that brings us to stock number 3, which is Nvidia, stock ticker NVDA. There is no question that the clear leader in 2023 was Nvidia, and that momentum has continued here in 2024. The company is firing on all cylinders. They build the most powerful, highest quality, fastest chips on the market today, and they're used in a variety of different sectors, from obviously AI or artificial intelligence, gaming, also automotive, and many other places. Nvidia has seen their market cap explode over the past 12 months, as it currently sits at $1.47 trillion, making it now one of the largest companies on the US market. As I mentioned, the market cap exploded given that the share price climbed more than 250% over the past 12 months alone. And unlike Meta, which is flat over the past few years, shares of Nvidia are up over 1,500% over the past 5 years. The company has simply been unstoppable, and their backlog of orders that they have coming in continues to grow as well. They simply can't build chips fast enough. To give you an idea on how strong their sales have been, Looking here, you can see that the company generated revenues of $27 billion in FY 2022. In the company's latest quarterly report, the company generated more than $18 billion just in that single quarter, nearly 70% of what the company did in the full year of 2022. As such, full year sales in 2023 are going to far surpass that of 2022. Turning our attention to the balance sheet, we can see that the company has total cash of more than $18 billion when you include marketable securities. Total debt for the company equates to less than $10 billion, putting the company firmly in a positive net cash position. Nvidia is a high margin business. With that long backlog, strong management team, this is going to be a company to reckon with for a number of years. But after a year like that, how does valuation stack up? In FY 2024, analysts expect the company to generate EPS of $20.45 per share, which would be 67% growth year over year. This equates to a forward PE multiple of 29 times. 29 times for 67% growth is wild, as that puts a PEG ratio well below 1, suggesting the PE you're paying compared to the growth you're getting is extremely undervaluing the stock. Now again, these are estimates, so the company has to deliver, but delivering is what Nvidia has done best over the past few years. As such, when it comes to rating the stock, Nvidia is easily a must-own stock for me, and I don't believe many would argue with my assessment there. And that brings us to stock number 4, which is Advanced Micro Devices, otherwise known as AMD. So we just looked at Nvidia. Now let's look at another chip maker and a close competitor to Nvidia, which is AMD. Now, AMD had a phenomenal year in 2023, albeit overshadowed by that of Nvidia. And the company is off to an extremely hot start here in 2024, where they're already up over 20%. AMD shares currently trade at a market cap of $281 billion. So in terms of size, much smaller than that of Nvidia. And over the past 12 months, shares are up 150%. AMD makes powerful desktop and laptop computer chips that are utilized for artificial intelligence and among other things. But everyone right now seems to be focused on how they can utilize and how they can bring AI power into their company. Looking here at the company's balance sheet, you can see that AMD has cash of $5.8 billion when including marketable securities, and they have total debt of $2.5 billion, giving the company a positive net cash position of $3.3 billion. Looking here at revenues, anytime we have a chart looking like a staircase higher when discussing revenues is certainly a good thing. The company generates higher revenues year in and year out, and we'll see them close out their fiscal 2023 when they report their Q4 earnings here shortly. Margins are also high, but not nearly as high as Nvidia. Looking at past results is great and all, but a lot of what goes into valuing a company and valuing a stock is more about what the company is going to do for me in the future. Looking ahead, analysts expect AMD to grow its EPS by 42% in 2024, generating $3.77 per share. This equates to a forward price-to-earnings multiple of 46.2 times, which is much higher than that of Nvidia, even though both stocks have been hot to start 2024. From a PEG standpoint, AMD shares have a PEG of 1.1, still intriguing, but not as intriguing as Nvidia. When it comes to rating the stock, there's a lot to like about AMD, especially moving forward, but it's hard to put them on the same level as Nvidia right now. Therefore, I will drop them down a spot and rate them in the high quality bucket. And that brings us to the 5th popular stock on our list today, which is Intel Corporation, stock ticker INTC. This is obviously another chip maker, and I promise the last chip maker on our company today. Competitors with the likes of Nvidia and AMD, but probably closer aligned with that of AMD, focusing more on the desktop and laptop computers. When it comes to a company like Intel, investors are split. On one end of the spectrum, you have the investor that has sold out of their position entirely, just done with the over-promise, under-deliver. However, right now, under the leadership of CEO Pat Gelsinger, the company is going through a transition, a turnaround story. And on the other end of the spectrum, you have investors that are hoping and believing in this turnaround story. And when it comes to me, I too am split on the stock. There's part of me that says they have overpromised so many times, quarter in and quarter out, and underdelivered. And they're talking about this turnaround story for what seems like years now, but it's not coming to fruition. How long do I have to wait? My money could be put better to work elsewhere. However, there are investors that are waiting for that turnaround story to come to fruition. When it comes to Intel, the company currently has a market cap of $203 billion. And over the past 12 months, the stock has increased by nearly 70%, finally gaining some strong momentum. Taking a look at the balance sheet, where we see the company has cash on hand of $25 billion, compared to total debt, though, of nearly $50 billion, putting the company deep in a negative cash position. Not ideal from an investor standpoint. In addition, the company is investing heavily in this turnaround story, investing billions in capital expenditures. So if this turnaround story doesn't turn around, this is a company that's going to be in big trouble. Through the first 9 months of the company's fiscal year, they have spent nearly $20 billion in capital expenditure costs, while generating only $6.8 billion from operating activities. So you can see deep negative free cash flow. Looking here, we can see that revenues have been stagnant from 2019 through 2021 before falling hard in 2022. And looking at 2023 so far, we are expecting the company to have revenues even lower than that of 2022. But the CEO is telling a big story, calling for billions in free cash flow coming soon. For me, I've never been a big investor on hope. I'd rather see a company turn things around and prove it to me. It's one thing to have huge growth estimates moving forward. Say, for example, Nvidia. They have huge growth estimates for 2024, but they have shown me over the past few years, they've proven it to me. Not only do they hit those goals, but they surpass them. Intel has been the complete opposite. So what this means from an investing standpoint is I'm never going to pick the very bottom, but I'm also not going to get caught holding the bag. Looking at valuation, analysts are looking for the company to generate EPS of $1.88 in 2024, which equates to a forward PE multiple of 25.6 times for a company that has traded closer to a PE of 10.6 times over the past 5 years. When it comes to ranking Intel, I put the company in the prefer not to own category right now. And I say right now as that being the key. This does not mean forever, it's just right now. I'm taking the wait and see approach to see if they truly turn things around. And that leads us to our sixth and final stock, which is Alphabet, stock ticker GOOGL. I'd like to say I saved one of the best for last, formerly Google, which happens to be the largest single stock holding within my portfolio. And if you're interested in seeing my entire portfolio, consider subscribing to my newsletter, The Investor's Edge, where we send out a weekly market recap every single week, straight to your inbox for all subscribers. And for premium subscribers, you can check out my entire portfolio, where I do monthly portfolio updates. We do earnings recaps. We also publish every single Monday our Edge report and much more. Definitely check out the link down in the description below. So when we're talking about Alphabet, a lot of what I discussed about meta platforms and the increase in digital advertising is going to be the same for Alphabet. Although Alphabet owns the two largest search engines in the world, one being Google and the other being YouTube, which is exactly where you're watching this video right now. Shares of Google currently trade with a market cap of $1.8 trillion, and over the past 12 months, Alphabet shares have climbed by nearly 60%. Looking at the balance sheet, the company is quite strong with a cash position of more than $110 billion, with total debt of nearly $14 billion, putting them firmly in a positive net cash position, backing up their AA+ credit rating. I fully expect that strong cash position to continue rising as the company generated $40 billion in free cash flow just in the past 9 months alone. When looking at revenues, similar to that of AMD, we're getting the staircase higher look, a good thing. Gross margins are solid at 55%, and the most recent quarterly data was even higher. Alphabet is a rock-solid company with plenty of growth drivers, not just advertising, but you can even throw AI in as well. In terms of valuation, analysts are looking for the company to generate EPS of $6.68 per share in 2024, which equates to a PE multiple of 21.9 times. Over the past 5 years, shares have traded closer to 25.6 times. So when it comes to ranking, Alphabet and Meta are giants within the advertising space, both with huge amounts of customer data. But cash flows and strength of the balance sheet nudge Alphabet a little higher, which is why I rank Alphabet a must-own stock for me. All right, so now we've gone through 6 popular stocks and put them in various different buckets. But now let's actually rank them from my least favorite to my most favorite stock. And again, these are just my opinions alone. Beginning with stock number 6, which should come as no surprise, and that is going to be Intel. The turnaround story is there, but yet to be confirmed. So I will take a wait and see approach. Coming in at number 5, which might come in as a surprise, is Apple. Extremely quality company from a product standpoint, and I understand the service revenue transition, but the lack of growth combined with the multiple that has doubled over the past 12 months with very little in terms of revenue growth gives me pause. Number 4 is going to be AMD. Strong chip maker, not on the level of Nvidia, but smaller in size and still growing at a great pace. This is a company I love to trade options with also. And then that moves us to number 3, which is Meta Platforms. CEO Mark Zuckerberg coined last year the year of efficiency, and he delivered. The company is in much better shape than it was 24 months ago, which is why I've ranked them so high. And the value is actually quite intriguing. However, they can't quite edge out number 2, which is Alphabet. Stock ticker GOOGL, and again, the largest individual holding within my portfolio, and a dominant player with the top 2 search engines being Google and YouTube. Which then leads us to my favorite stock right now, which should come as no surprise, and that is Nvidia. You can't say enough good things about them right now. Fire on all cylinders. A great management team. The stock up huge, and it still looks cheap when using forward estimates. So with that being said, we have now concluded looking and ranking these 6 popular stocks. Down in the comments section below, I would love to hear your rankings. How would you rank these from your most favorite down to your least favorite? Number 1 being your most favorite, number 6 being your least favorite. I would love to see those down in the comments section below. And if you haven't done so yet, make sure you smash that like button, as it truly helps the growth of this channel, and I truly appreciate it, and we'll see you in the next one. Take care.